Yeah.
Oh, yeah. My favorite part. No offense. That's okay. Favorite part.
You see people look stupid.
You ready?
Yeah, I just realized I forgot what time the event starts. You're coming, aren't you? No, I heard you might be.
Virtually online.
All right, TV.
Stop. Oh, thank you for that. Hey guys, just a really quick announcement is that Follies is this Friday. Thank you. It's going to be really funny. Contrary to popular belief, it's not just videos. There are going to be a lot of like live dance numbers, singing, all your favorite 90s hits, some of your favorite professors, a lot of like secret cameos and surprises. Tickets are $20. It's usually considered like the most fun event of the year. All the details about where and when are on campus groups. So buy your ticket on campus groups or in the lobby. But again, it's this Friday. It's super fun. You don't want to miss it because it's what everyone talks about next week. All right, thanks.
"31 years, I've never gone to Follies." At least in person. Though it's been the source for almost every embarrassing moment that I've ever had in my life. It's had to be Justin Bieber one year. That wasn't bad. The worst year ever for me was when they made me first they made me put an afro on, an afro wig, and I had to walk from school down 4th Street, or actually 3rd Street. There used to be a 70s bar called Polyesters down the street. So I had to walk doing the Saturday. Have you ever seen Saturday Night Live, the John Travolta walk? I had to do the John Travolta walk from school to Polyesters. Luckily, this is New York City. People weren't even phased, right? Guy obviously doesn't have an afro, wearing an afro wig, doing the John Travolta walk. So, do go. It should be fun. Anyway, the fun part, though, is on Friday. So before that, we have some less fun stuff to do, and I want to remind you of the less fun stuff. Now, if it looks like I'm weeping today, it's nothing to do with you. There's a there's a quiz on Wednesday at 10:30, so remember that. There'll be a review session tomorrow from 12 to 1 in this room. It's overkill because there'll be only about 35 people at the review, maybe 50. But obviously, if all of you show up, that's fine too. But it will be recorded and webcast, so by 3 o'clock or 4 o'clock tomorrow, you should be able to watch the webcast. It'll cover everything through capital structure, so page 1 through page 142, 143, somewhere around there. So everything on capital structures. Take a look at the past quizzes if you haven't already, because you'll get a sense of what the process is. And keep working on the project. That's due 2 weeks from today. Last day of class is 2 weeks from today. With all those reminders behind us, let's get back to where we were on Wednesday. We were talking about dividend policy. And I laid out some very broad things about dividends. They're sticky, that they follow earnings, that increasingly they are being moved to stock buybacks, and finally that they are a function of tax law. There's one more page I wanted to show you before I kind of moved on to the specifics of dividends. And this is a page that actually I want to use to illustrate two things. The first is, when you were a kid, have you ever played one of those games where you have 8 pictures on a page and you have to tell me which one doesn't fit? These are 8 countries out there, and you tell me the one that doesn't quite fit. Okay, you get it, right? I've never understood why we went from a G7 to a G8. It never made sense because Russia, while it's always been a political power, really doesn't belong in this game. So it kind of sticks out. But there's another point I want to make. If you look across the G8, clearly Russian companies don't pay very much in dividends. Remember we talked about dividends being residual. Whatever's left over gets paid out to stockholders or could get paid out. But managers don't have to, right? So in a company, let's assume a company can generate cash flows, but it's not paying those cash flows out as dividends. How do stockholders get managers to pay those dividends? They put pressure on them, right? Maybe not as small stockholders, but maybe larger stockholders, activist investors. Now do you see why Russian companies feel no urge to pay dividends? Let's say you own stock in a Russian company, Gazprom. You don't like their dividend policy. So you fly out to Moscow. Bad mistake already. You announce you're going to challenge dividend policy at Gazprom. Just make sure you jump on the plane right after you made the announcement and leave right then, because you might not make it back. If you cannot put pressure on managers to give cash out as dividends, guess what? They're going to hold the cash back. Why would managers want to give you the cash and they lose control over it? So this ties back to what we were talking about in terms of corporate governance. If you have a company with weak corporate governance, do not be surprised to see it accumulate cash, because there's not a whole lot you can do to get them to give you the cash. Okay? So with that in mind, let's think about how to measure dividends at a company. There are 2 ways you can measure how much a company pays in dividends. You can look at the percentage of net income that gets paid out as dividends. That's called the dividend payout ratio. Or you can measure dividends as a percentage of the stock price. That's called the dividend yield. They're both going to be correlated. When one is high, the other will tend to be high, but they measure 2 different things. So what I'd like to do is show you what the distribution looks like. And if you can, when you get a chance, look at your company, you can at least get a measure of whether your company is paying out high dividends or low dividends relative to what most companies do. So the first graph I'm going to show you looks at dividends as a percentage of net income. Okay, so dividends divided by net income. It's called the payout ratio. And this is the payout ratio for both US and global companies in January 2016. So you can actually see the distribution. Let me back that up. This is the dividend payout ratio for companies that pay dividends in the US. In a minute you're going to see why I draw that distinction. Among dividend paying companies, this is what the payout ratio looks like. The median dividend payout ratio for a US company across all companies is only 12%. But the median payout ratio among US companies that pay dividends is about 35 to 40%. It's kind of a strange distinction, right? So the median payout ratio across all companies is only 12% for US companies. Across companies that pay dividends, it's a higher number. That's because a lot of US companies don't pay dividends. Out of my sample of 8,000 US companies, about 3,500 did not pay dividends. So in fact, that's actually a number that used to be higher than 50%. The median payout ratio for a US company used to be 0%. Now it's about 12%. But basically, if you look at companies that pay dividends, a payout ratio of about 30 to 40% would put you right in the middle of the distribution. If your company is paying out 70, 80, or 90% of its earnings as dividends, it's paying out a high dividend payout ratio. And if it's paying out 10, 5, 3%, it's a low payout ratio. But there are some interesting companies here, and there are quite a few. For both among the US, about 15% of US companies, about 14% of global companies pay out more than 100% of their earnings as dividends. Are they insane? And why would a company pay out more than 100% of its earnings as dividends? They could be. Let's not rule that out. But let's think of good reasons why you might have a payout ratio greater than 100%. I can think of at least 3. Let's see if you can nail down a couple. Why might a company pay out more than 100%? It's a single year. Well, maybe, or that their earnings dropped off, one or the other, right? In fact, if you're looking at a single year in a commodity company and the earnings dropped in 2015, you might continue to pay dividends on the hope and prayer that earnings will bounce back. So if you're a cyclical or a commodity company, I wouldn't be surprised to see payout ratios greater than 100%. The second is, if you're a real estate investment trust or a master limited partnership, you're required to pay out 95% of your earnings as dividends. Not more than 100%, but 95%. But then because you're a real estate investment trust, because you have depreciation and other non-cash charges, your cash flows could actually be much higher. So maybe that's the second group of companies that are, through the process of law, required to pay out high dividends. What else? Yes? Be more specific. What when you say dividend recapitalization, what are we talking about?
So we're talking about a company that has been bought by a private equity firm.
Right.
And they basically cash out part of their investment.
Yeah, in fact, the private equity is not even required, right? So if you are, remember we talked about life cycle for companies? You have young companies, you become mature companies. What's the last stage of the life cycle? You go into decline. What does that mean? Your business is shrinking. You want to get smaller. IBM for the last 12 years has been paying out far more to its stockholders than its earnings, and as a company it's actually shrunk. Is that a bad thing? If that's a reality you face, that's exactly what you should be doing. So the third group of companies that might be paying out more in earnings than dividends are companies that are trying to make themselves smaller because they don't feel there is enough business out there for them to keep growing. So what I'm saying is, if you have a company which has a dividend payout ratio more than 100%, don't give up on it and say, this company is crazy. Look to see whether there are good reasons first. And if you cannot find them, then start digging a little deeper and say, is this company putting itself in danger by paying out what it can afford to in dividends? So that's the first, is the payout ratio. And you can see across markets, the US has the lowest payout ratio. Does that mean US companies return less cash in dividends than other markets? What's a compensating factor you get in the US? This looks at just dividends, yes. We don't include stock buybacks. If you include buybacks, the US returns a little more than the typical company in the market, but without including buybacks, you're always going to see US companies look like they return too little in dividends because they've shifted away from dividends. Okay? Here's a second way in which you can measure dividends. You can divide the dividend by the stock price. You're saying, what does that tell me? Well, remember how we computed the expected return for a stock based on its beta, risk-free rate plus beta times risk premium? And you did that for each of your companies, 9, 10, 11, 8%, whatever it is. That return to you as a stockholder comes from two places. Some of it comes from dividends, some of it comes from stock buyback. I'm sorry, price appreciation. The dividend part of it is captured by your dividend yield. So if you have a typical company, in the case of Disney, for instance, the expected return was about 8% or 8.5%. The dividend yield was about 1.5%. So the rest, the 7%, had to come from price appreciation. So the dividend yield tells you what percentage of your return comes from dividends. And if you look across, again, companies, the median dividend yield for a US stock is now about 1.5 to 2%. So if your stock pays out a dividend yield much greater than 1.5%, it's paying out more dividends than the typical company. And if it pays out less than 1.5%, it's paying less dividends. And again, don't be surprised to see a 0 dividend yield. fact, I want to put something on the table. I've had people skip this entire section on their project because their company did not pay dividends. Don't do it. Is the policy of not paying dividends a dividend policy? Yes. In which case you still have to ask, does that make sense? So just because a company doesn't pay dividends doesn't mean you have the license to say, this doesn't apply to me, my company doesn't pay dividends. So you can have a 0 dividend year. And there's an interesting trap embedded in this particular graph. What's the T-bond rate right now? Come on, you should know this off the top of your head. You were doing the project yesterday, or day before, or the day before that, or sometime before. It's like 1.8%, right? Just saying, so what? Historic lows, right? If you bought stock if you bought corporate bonds today, let's say you bought a high-grade corporate bond, AA, single A, you're making 3%, 3.1%, 3.2%. You're saying, so what? Let's say you're 65 or 70 years old, okay? You've got entire savings, you don't want to take any risk, you want to invest it in something safe, but you need the income from your investment to keep going. Life's become very difficult for you because there aren't that many choices available to you. I think you're ripe for a scam game. Like what? If I offered you a stock with a 6% dividend yield, sounds really good to you, right? 6%, much higher than what you can make on a T-bond. So as you look at those stocks with 6, 6.5%, 7% dividend yields, they look like they're too good to be true. And guess what? Most of them are too good to be true. If you buy a stock with a 7% dividend yield, either you've got the greatest buy in history, or there's something about the stock you should be checking out. Like what? That maybe they can't pay these dividends for very much longer. You're just ahead of a dividend cut. In fact, some of you might have been reading about the Sun Edison bankruptcy towards the end of last week. Sun Edison is a green energy company. That's neither here nor there. So this isn't a diatribe about green energy. But what Sun Edison did about 3 years ago was they took their, as an energy company of plants which produce power, which get cash flows, they took their biggest cash flow generating assets and they spun them off into what were called yieldcos. You know what a yieldco is? It's basically like a master limited partnership. It's separated from the company. So what you've done is you've taken your biggest cash flow generating assets, you've separated them as entities that people can buy shares in. If you buy shares in these companies, what you're offered are the cash flows from the plant. So these yieldcos offer dividend yields of 5, 5.5, 6%. But there are two catches. One is, if you're paying out all the cash flows from this plant, remember it's a standalone investment, right? I'm not sure you can get any growth out of this because in a sense, all the cash flows leave, you can't get growth because nothing's being reinvested. That's the first problem. The second is, it's a finite life investment. Do you see what I mean? Unlike a bond where you get the face value back, at the end of 25 years when I shut this plant down, there might not be much in terms of liquidation value. So the dividend yield is a little deceptive because it looks high, but part of it might be just capital being returned to you ahead of time because it's a 20 or 25-year investment. I think yieldcos are destined for a bit of a fall, and Sun Edison might trigger that because people think about these as if they were regular stocks. So they can get 5.5% dividends forever. You can't do that. There's no way with this structure you can keep paying dividends in perpetuity. So when you look at a dividend yield, kind of step back and think about it, especially if you have a really high dividend yield, what might be driving that dividend yield? Any questions? Banks are another notorious group where dividends now have become pretty high on some banks, but those are exactly the banks where regulatory capital is also under assault. So they're issuing shares on one hand, paying dividends. It's crazy, but they keep doing it. Okay? So first way to think about dividends is to think in terms of the life cycle. Think about where your company falls in the life cycle, and that should kind of give you a sense at least of how much you should expect to see in dividends. So if you're a young company, startup, high growth company, I shouldn't expect to see any dividends. Partly because initially you're not making money, but even when you start making money, all that money should be going back into the company to create future growth. As you become mature, just like with debt, your capacity to pay dividends opens up. And initially, just like with debt, you fight it. You fight it because you want to return to growth. So you have the capacity to pay dividends, you fight it. So what are you going to observe with these companies? At young growth companies, when they start to become mature and they refuse to pay dividends. What are you going to see in the companies? Increasing cash balances, right? Because that's what it'll show up as. And you look at technology companies, that's exactly the first step in, hey, getting past the denial is your cash balance goes from 30 to 50 to 60 to 80 to 90 to 100 billion. Finally say, you know what, that great investment is not coming. We have to think of ways of returning cash to investors. So mature companies, you start to return more cash, whether it's dividends or buybacks. And then you go into decline. You might be returning more cash than you're actually bringing in because you're trying to make the company smaller. So across your 5 or 6 companies in your group, it might actually make sense to plot them as to where they are in the life cycle and look to see whether they're acting their age. And just to kind of back up that this life cycle hypothesis has legs, what I did was I took companies in the US and I broke them down based on the expected growth in earnings per share in the next 5 years. So these are analyst estimates, so take them with a grain of salt. So these are companies with 0 to 3% growth, 3 to 5, 5 to 10, 10 to 15, all the way up to more than 25%. So I broke down all the companies based on expected growth rates. Then I measured the payout ratio and dividend yield in each group. Companies that have very low expected growth tend to have payout ratios of about 45% and dividend yields of about 3.6%. And as the growth increases, notice how the payout ratio and the dividend yield drop off. It's exactly what you should expect if there's a life cycle hypothesis driving dividends. Right? Any questions? So let me lay out at least what my companies look like before I jump into looking at the trade-offs and dividends. So this is Disney, Vale, Tata Motors, Baidu, and Deutsche Bank. I have the dividend yield using the last 12 months of data and the dividend yield looking at 5 years of data. Why am I intent on looking at 5-year averages? Because I do know you can have good years and bad years, and I want to see what the payout ratio and yield look like over time. If I take Disney, the trailing 12-month dividend yield was about 1.09%, and the payout ratio was about 22%, and that's not that different from a 5-year average. So I think that was a waste of time. Why do you even compute a 5-year average? Take a look at Vale. The trailing 12-month dividends when I did this was 6.6%. And the payout ratio was 113%. Why? Because it's a commodity company that thought that iron ore prices would bounce back up, so it continued to pay dividends like they were going to come back. And if you look at the last 5 years, the dividend yield was still high, but it's lower than the 6.56%, and the payout ratio drops off. So if I put my money in Vale, saying this looks like a really good stock, pays a high dividend yield, in 2013, that dividend's been cut, partly because they don't have the earnings to continue to pay the dividends. But that's, I think, so we have to be careful about high dividend numbers because they might be transient. Tata Motors, 1.31% and 16%. If I use trailing 12-month numbers, those are lower than the 5-year averages, which are 1.8 and 15.5%. Again, not much of a shift. So it's more like Disney than Vale. Baidu, that was a nice column to compute, 0, 0, 0, 0. Nothing, no dividends. And that again makes sense, right? Young, high growth company. And Deutsche's dividend yield was 1.96%, but its payout ratio was 362%. You think they paid a lot in dividends? They didn't pay a lot in dividends. Their earnings collapsed. Their dividends stayed where they were. It's the sticky dividends. It's exactly what this is going to get you. Finally, Deutsche had to cut dividends a couple of years ago because the regulatory capital became dangerous enough that they had to do it. They were forced to cut dividends. So here's what I'd like to do. I'd like to lay out 3 schools of thought in dividend policy, and they kind of span the spectrum. The first school of thought says if there are no tax disadvantages to investors, so you're the investors, and you don't care whether you receive dividends or capital gains, you're indifferent, and companies can go out and raise equity when they want to without having to pay transactions costs, flotation costs, no investment banking fees, it does not matter how much you pay in dividends. Let me repeat that again. If there are no tax issues to investors between dividends and capital gains, and companies can raise equity whenever they want without flotation costs, it doesn't matter how much you pay in dividends. Does it sound a little familiar? Didn't we just a few sessions ago talk about something else that didn't matter? It didn't matter how much you borrowed. That was Miller Modigliani 1. This is Miller Modigliani 2. Miller Modigliani 1 says, in a world with no taxes, no default risk, and no agency costs, it doesn't matter how much you borrow. Miller Modigliani 2 says, In a world with no tax differences for investors and free capital markets, it doesn't matter how much you paid in dividends. If we lived in a Miller Modigliani world, we could have ended this class about 5 sessions ago. Right after capital budgeting. Because in a Miller Modigliani world, all that matters is you take good investments. Everything else is a side thought. It doesn't really matter. So think of that as one end of the spectrum, or right the middle of the spectrum. It doesn't matter how much you pay in dividends. There's a second school of thought, and this was developed primarily in the last part of the last century, when tax law in the US was clearly tilted towards capital gains. And this school of thought said that paying dividends is silly, because if investors receive dividends, they have to pay 50, 60, 70% of the dividends as taxes, but if they got it in capital gains, it would be 20 or 25%. So the second school of thought says, given the tax disadvantage associated with dividends, don't pay dividends. That's it. So dividends are bad. And there's a third school of thought that kind of rounds out the entire spectrum. And it says that if your investors like dividends, and there are some investors who like dividends. Sure, for whatever reason, they like the cash flows, they don't pay taxes, whatever it is. If your investors like dividends, just like the customer is always right in marketing, if your investors like dividends, pay them more in dividends. So dividends don't matter, dividends are good, dividends are bad. This is extremely unfortunate, because if you're a CFO, no matter what you do, you've got an entire school of thought backing you up, right? If you increase dividends, you point to the dividends a good school. If you cut dividends, you point to the dividends a bad school. If you have no idea what you're doing on dividends, you say, Miller Modigliani. All three schools have an element of truth, but they all have limitations. In fact, they all three can apply. So here's what I'm going to do. I'm going to start with the Miller Modigliani school and then kind of move through the spectrum. But let me start off by stating what I think about dividends. I think all these schools of thought bring something to the table. And here's the way I think about dividend policy. If you're a company that has lots of cash coming from operations, and you don't have very many good projects, then I think you should return more cash to your investors. Make sense? I mean, we can debate all the little nuances, but if you have lots of cash, not very many projects, give more cash back to your stockholders. If you have not that much cash coming in from investments and lots of potential investments to make, then you shouldn't be returning cash to your investors. It's as simple as that. So if you can somehow measure how much cash is thrown off by operations and what kind of investment opportunities you have, we should be able to make a judgment on dividend policy. So what I'd like to do actually is start with a Miller Modigliani argument and see why it works. Okay? So let's say you're a company. You generate $250 million in income, and you're saying, how much should I pay in dividends? Let's say you can afford to pay 100. That's what's left over. But you pay $200 million instead. You pay too much in dividends. What does the Miller Modigliani say? It doesn't matter. How can it not matter? If you pay too much in dividends, you have a problem, right? You have a $100 million deficit. In the Miller Modigliani world, why doesn't it matter? What do? You go out and issue new shares, and you cover the $100 million. Wouldn't investors be affected? Not really, because when you're an investor in this company, you're going to get a really high dividend and less price appreciation. Because when I issue those new shares, you have more shares outstanding, so you have to share the price with more people. So you get exactly the same return. The composition will change, but you don't care because you're not affected from a tax perspective. So in the Miller Modigliani world, it doesn't matter if you pay too much in dividends because I make up for it. What if I could pay 100 million dividends and I don't pay out dividends? In the Miller Modigliani world, I still take exactly the same projects I did before. I build up cash in the company for you. It's your cash. So you as investors get zero dividends, but your price appreciation is going to be much higher because the price will reflect the cash I hold. So in the Miller Modigliani world, it doesn't matter if I pay too little in dividends. That's the basis for the Miller Modigliani argument. So for this to work though, you as investors have to be truly indifferent between dividends and capital gains. And I as a company have to be making exactly the same investments whether I pay 200 million in dividends or nothing in dividends. So in other words, I've got to compute the net present value, take good investments. I'm not tempted when I don't pay dividends to go out and take more investments. So it assumes rationality on the part of investors, rationality on the part of companies. Strong assumptions, but think of that as the limiting case. Those are the scenarios where it doesn't matter how much you pay in dividends. Let's take the dividends are bad school. This is a graph where I've never quite figured out what the best way to graph this is. I've actually graphed out the purple line is actually the tax rate on dividends each year going back to 1916. 1916 was when the Supreme Court actually found that the income tax was constitutional, because until 1916 this was contested whether you could have a federal income tax because only states were allowed to tax people. So the graph starts in 1916, the modern century in terms of taxes. So 1916 to 1922, dividends and capital gains were taxed at the same rate. Starting in 1922, you can start to see the two start to separate. The purple line is the dividend tax rate. The gray line is the capital gains tax rate. And if you complain about how much taxes you pay on dividends today, I'm going to take you back to, let's say, 1954. What is the tax rate on dividends? 90%. At which point you're saying, why are you even mailing me the dividend check? Just send it directly to the IRS, right? And there's the capital gains right there at 26%. Now do you see the basis for the dividends a bad school? When I pay dividends, and if you're a taxpayer, two caveats. This is the highest marginal tax rate. So this is if you're the wealthiest person, and already you can see the open space I'm leaving you. If you're not as wealthy, will it affect you? But among the wealthiest investors, it clearly didn't make any sense to pay dividends because you got taxed at 90%, and on capital gains you got taxed at 26%. That difference narrowed a little bit in the late 70s. Then it narrowed further as the tax rate on ordinary income came down. 1986, for a very brief period, like 3 years, the tax rate on dividends and capital gains converged at 28%. It's almost like the US Congress cannot stand to have the same tax rate on dividends and capital gains. It's almost like pressure builds up. And that pressure built up again. 1990s, you see the dividend tax rate climb again. Then you get to 2003. And since 2003, this is the longest stretch we've had, about 12 years, we've had the same tax rate on dividends and capital gains. So this year when I filed my tax returns for my dividends and capital gains, I was paying roughly 24% of the income I received on both. Why 24? Because it's 20% plus there's a 3.8% healthcare tax on, this is called unearned income, which pisses me off no end. No, what do you mean unearned income? Who do you think earned the income that went into the stock that got me the dividend? But it's unearned income, and I get punished for having unearned income. Yeah. So it's about 24% right now. So the basis for the tax argument has always been that the tax rate on dividends is higher than capital, but it's disappeared now, right? So now there should be no tax difference. But let me ask you a question. The tax rate today on dividends and capital gains is the same. But do you think there's still a tax advantage associated with capital gains? I think there is. What is the tax advantage that you still get with capital gains that you don't get with dividends? Yes, Michelle. And when you say offset your losses, that comes from the fact that you can also time when you get the capital gains, right? Because when do you get taxed on capital gains? When you sell. And who decides when to sell? You do. Which means that if you have capital losses, you can decide to strategically take capital gains that year and offset them. Dividends, you have no choice. You can't tell the IRS, well, I didn't really need the dividends this year. I got all these dividends from Coca-Cola. I'm choosing not to pay taxes this year because I really didn't. It doesn't work that way. It's called the timing option that you get with capital gains, which means that effectively you can still earn a slightly, it works out to be a slightly lower tax rate. And also tax rates vary widely across the market, right? First, do all investors in the market pay taxes? Or there's a subset. About 35% of investors in markets are investors who pay no taxes on dividends and no taxes on capital gains. Who are these investors? So what? Foundations, endowments for universities, but they're a very small percentage. They're definitely not 35%. There'll be about 1%. It's a much larger chunk. Pension funds. So when your money and my money goes into 401ks and pension funds, that pension fund money, which is about 35% of the entire market, pays no dividends and taxes, and they never have. So already you can see that that's going to create. Among the people who pay taxes, of course, tax rates vary depending on whether you made $25,000 in income or $250,000 in income or $1 million in income or $5 million. But to add to the confusion, even within an investor's portfolio, different parts of his portfolio have different rules, right? You know what a Roth IRA is? All of you should be opening Roth IRAs. Even if you don't have the cash, borrow the cash from your parents, open a Roth IRA. I don't think you can do that. You need earned income of up to $5,500. On a Roth IRA, here's what you get. That income has to come out of after-tax. So what you're putting into the Roth IRA has to come out of after-tax income. But that $5,500, once it goes into Roth IRA, what happens to it? The income you make on a Roth IRA is untaxed. So if you invest that in a high dividend paying stock, you can receive dividends for the next 32 years tax-free. And then finally, when you start taking the money out, when you're 65 or 70, you might have to pay taxes. But even then, it's questionable if you're, if it's low enough that you can qualify for some kind of exemption. All I'm trying to say is taxes are really, really messy because there is no one tax rate that applies across investors. So if I asked you as a company, let's say you're a company, say, are investors in your company more fond of dividends or capital gains? Which ones do they get taxed on more? The answer that most companies will give you is, we have no idea. So I'm going to give you a simple way. It works some of the time, it doesn't, but it's actually a very interesting way to think about whether investors in a company or what they think about dividends on capital gains, taxes on capital gains and taxes on dividends. You know what the ex-dividend day is for a stock? Michelle, what's an ex-dividend day? What happens on it? In the old days, remember it used to be, it was actually on papers. They used to have a stockholder roster, and they would shut the roster down on a specific day. So if you bought the shares before that day, you were entitled to the dividend. If you bought them after the day, you wouldn't get the dividend. In fact, when you think about dividends, there are 3 dates of significance. There's the dividend announcement day. That's when the board of directors gets together and says, this is what we're going to pay in dividends. That's the date on which you get the stock price reaction to dividends being raised or lowered, because that's when you get information about the future. That's the first day. There's the ex-dividend day. That's a date by which the roster gets closed and they decide who gets the dividend. And there's, of course, the payment day. The check gets mailed out. That's the least interesting of the 3 days, even though it might be the day you care about the most. The ex-dividend day is the date by which you got to buy the stock to collect the dividend. So what? Let's play a game. Let's assume we're all investors in a company. We bought shares 5 years ago. Why 5 years ago? You're going to see in a minute, because to qualify for capital gains, you got to hold shares for more than a year. So we all bought shares 5 years ago. Let's say we all bought it at some price, an IPO price of P. Tomorrow is going to be an ex-dividend day. And each of us has a choice to make. We can sell before the ex-dividend day and forego the dividend, or wait until after the ex-dividend day and sell after. You're saying, who'd be stupid enough to sell before? Well, the price before the ex-dividend day and the price after is not going to be the same. So if you sell before the ex-dividend day, you get PB. If you sell after the ex-dividend day, you get PA. But if you wait and sell after, you also get a dividend of deal. For the moment, just hang in there with the abstractions. Let's look at the cash flows each of us would get by selling before as opposed to selling after. If you sell before, here's what your cash flows will look like. You're going to get PB, and you're going to have to pay capital gains taxes on the difference between PB and what you originally paid, P, times the capital gains tax rate. Okay? So think of that as your cash flow if you sell before. If you sell after, here's what your cash flows will look like. PA will be the price after. You pay capital gains taxes based on PA, but you'll also get the dividend net of the ordinary or the dividend tax rate you'd pay on dividends. You're saying, where's this going? So basically, I have the cash flow from before, the cash flow from after. Let's do some what if. Let's assume that the cash flow from selling after was greater than the cash flow from selling before for every one of us. Nobody would sell before, everybody would sell after. That's not a stable market. If the cash flow from selling before was higher than the cash flow after for every one of us, everybody would sell before, and that's not a stable market either. For this to be a market that has any degree of stability, most of us have to be indifferent. Most of us, not all of us, most of us will be indifferent between selling before and selling after. Which means for most of us, here's what's got to be true. The cash flow from selling before has to be equal to the cash flow from selling after. And if you work through the algebra, it turns out that that indifference point will occur when the price drop that you have on the ex-dividend day as a percentage of the dividend is equal to the ratio of the taxes you pay on dividends versus the taxes on capital gains. Take a look at that equation. So what you see happening on the ex-dividend day to the price relative to the dividend will be a function of what your ordinary tax rate is or the dividend tax rate is versus the capital gains tax rate. So let's say you as investors really pay the same taxes. You're indifferent in terms of taxes. Your TO is equal to TCG. What you pay on dividends and capital gains is the same. What should happen the ex-dividend day? What should the price drop be? If the ordinary tax rate and the capital gains tax rate are the same, the price drop should be exactly equal to the dividend. If you're taxed at a higher tax rate on dividends than on capital gains, let's say you're taxed at 40% on dividends and 20% on capital gains, what should you observe on the ex-dividend day? The price drop has to be smaller than the dividend, because if you put 40% in the numerator, 20% in the denominator, 1 minus 0.4, 1 minus 0.2, your price drop should be roughly 75% of the dividend. And if you're taxed at a higher tax rate on capital gains than on dividends, there are some countries where you don't get taxed on dividends, you get taxed on capital gains, then your price drop will actually be higher than the dividend. Who cares? That's an abstraction. Here's what I'm going to do. I'm going to observe what happens to your stock on the ex-dividend day. I can see that, right? I can see the dividend, I can see what happens to the price. If the price drop is roughly equal to the dividends, then I'm going to draw the conclusion that investors in your company are pretty indifferent between dividends and capital gains. I can't observe who they are, but because of the price behavior, I'm going to say they don't care. If, on the other hand, I observe that the price drop is consistently lower than the dividends, only 75–80% of the dividend, I'm going to conclude that investors in your stock, for whatever reason, see a tax disadvantage in dividends that they don't see in capital gains. And if the reverse is true, I'm going to draw the opposite conclusion. So I'm going to observe the ex-dividend day behavior for your stock and try to see whether I can, from that, extrapolate to what kind of taxes your investors face. So this is actually a phenomenon that's been studied in US markets going back to the 1960s. The very first study actually looked at 66 through 69. They looked at all US stocks. They looked at ex-dividend days across all US companies. They looked at the price drop relative to the dividend. And in that time period, they found that the price change as a percent of dividends was only 78%. You're saying, so what? File that away. So that's what they found in the late 60s. And remember, the late 60s, the tax rate on dividends was 70%. The tax rate on capital gains was 28%. There was a second study, went to 81 through 85, by which point the tax disadvantage of dividends had become smaller because the tax rate had gone to 50%. The price change as a percent of dividends had crept up to 85%. So as the tax disadvantage of dividends has gotten smaller, this number has gone to 85%. Then the third study actually looked at 86 through 90. Remember, that was one of the few periods where the tax rates had converged? And these researchers expected that the number would have become 1. What they found instead was that it still stayed at about 90%. That's the tax timing. So in spite of the fact the tax rates were the same, investors still seem to attach a bigger tax issue with dividends than with capital gains. I mean, I haven't seen an updated study, but even preliminarily looking at the numbers, I would say it's now about 93–94%. It's not 100%. So let's take that as a premise. Let's assume that on a typical ex-dividend day, the price drops, but it doesn't drop by the entire dividend. I'm going to ask you to tell me whether there's a way in which you might be able to make money on this. Yeah?
Does it matter that you have to hold the stock for a year in order to actually gain the capital gains tax? So wouldn't that change the numbers a little bit, because a majority of investors probably don't even fall into that year category?
See, but remember, what are you doing? The people selling are not getting the dividend. The people buying are getting the dividend. So the people buying don't care about holding a year. All they have to do is hold a day. The people selling have to have held for more than a year, right? So it is actually going to be a transfer of shares from people who've held the shares for a long time to people who need to hold it for only a day. You're right. From a capital gains perspective, I will need to hold it for a longer period. So I'm the seller. But you as a buyer, you can hold it for 15 minutes. You collect the dividend, and your stock price drops. So you don't care about capital gains. You actually get a capital loss. So you're right. The seller cares about time horizon. The buyer doesn't. Okay? But let me put you in from the perspective of a buyer, and you tell me whether there's a way in which you might be able to exploit this difference, the difference between the dividend and the price drop. Let's say you're a tax-exempt investor. You're a pension fund. And let's say that the price drop is roughly 90% of the dividend. And it's across all stocks, so clearly you got to average out. Is there a way in which you can make money as a tax? And I'll give you the choice, and you tell me which of these will make sense for you. You could invest in the stock for the long term. What will that do for you? Absolutely nothing. So cross that out. So it's kind of a... But the other two are potential starters, and you tell me which of these you do. You could sell short the day before the ex-dividend day and buy on the ex-dividend day, so after the stock goes dividend. Or you could buy just before the stock goes ex-dividend from me at PB. Hold it through the ex-dividend day, in which case you lose stock price, but you'll get the dividend instead. You see why the allure of that last strategy? What are you going to get? So if you have $1 in dividends, you're going to give up 90 cents in price change, and you're going to walk away with a 10-cent profit. That's called dividend capture, dividend arbitrage. It happens all the time. In fact, all you have to do is track stocks with very big dividends, and on the ex-dividend day, you'll notice the trading volume increases by 5-fold or 10-fold. Those are the tax-exempt investors coming in and buying shares from existing investors trying to capture the difference. You're saying only 10 cents? Yeah, it's only 10 cents, which means you got to do this on millions of shares. Don't try this with 1,000 shares. It's really not worth the money. Even if you're tax exempt, you got to do it on millions of shares. And here's the way it'll usually manifest itself. It's a stock, let's say it's a stock is trading at 50, it's going to go ex-dividend on May 4th, it's going to pay $1, and the price drop is 90%. You go out and you buy 1 million shares of stock. So you got to do it in bulk. You wait till the stock goes ex-dividend, sell the stock for $49.10. That's a 90% drop in the price, and you collect the dividend of the stock. Net profit from this transaction is $100,000, and it might take you 15 minutes to buy, sell, collect the dividend, do all of it. First, is this profit guaranteed? Where's the risk in this strategy? The price drop, right? But I told you it was 90%. It's an expected price drop, right? And I'll give you a story to show the risk in this strategy. So this strategy has been around a long time. It's called the dividend arbitrage, dividend capture strategy. So in the late 80s, this treasurer for an Oregon county reads about this strategy in a finance practitioner's journal. And he says, this will be great. And he takes half the money of the pension of the Oregon fund, puts it on one stock on one day. Say, hey, that's what the strategy said. I could make money. The day he picked was October 19th of 1987. You know what the market did that day? The S&P 500 dropped 22%. Think about that. 22% drop in the market today would be what, a 5,000 point drop in the Dow? 22%. Do you think the dividend capture strategy worked for him that day? He got $1 in dividend, the stock dropped $20. For this to work, you got to do it across lots of stocks across time. And you're going to make small amounts of money on each one, but it'll build up over time. That's a dividend capture strategy. None of us is going to be able to do this on maybe on your Roth IRA. If you can get $1 million into your Roth IRA and buy 1 million shares. But that's basically what you're trying to do, is take advantage of tax differences. Any questions on dividend capture? So that's a dividends are bad school. Now let's talk about the dividends are good school. I want to first dispense with bad arguments I've heard for paying dividends. The first is what's called the bird in the hand fallacy, and here's how it goes. When a company pays a dividend, it's in a sense in your hands. It's guaranteed. A price appreciation is, it might be here, it might be gone, right? So the argument is dividends are more certain than capital gains. Therefore, I'd rather that a company pay dividends. The source of it seems like a reasonable argument, right? Stock prices can do strange things. A dividend is certain. That is true if you're comparing dividends today to capital gains in the future. But think of what happens on the ex-dividend day. The stock drops by roughly the amount of the dividend. You get a choice between whether you want $1 in dividends or just collect the dollar in price by selling at the end of the day. Dividends are not more certain than capital gains if you think of them on an apples-to-apples basis. So that argument has never flown with me. In fact, when you hear old-time value investors talk about how much they love dividends, it's often based on the premise that dividends are certain, capital gains are not. And they're comparing dividends today to capital gains in the future rather than dividends today to capital gains today. Here's the second argument. We had a really good year. We have lots of cash this year. Why shouldn't we pay it out as dividends? Because dividends are sticky. You start paying dividends after a really good year, you might be stuck paying those dividends in future years, and especially if you have good investments that you might have to take in those future years. Paying out those dividends today will put you in the hole, and you'll have to go out and raise capital in markets, right? And remember, you don't live in a Miller Modigliani world. When you issue shares, investment banks don't do it for free. There are flotation costs and transactions costs, and those costs can be substantial on stock issues. How big? This is actually a graph. This is actually from a study that's way old, but it kind of captures the effect of how much of the money you raise from new equity issues actually ends up in the company. So what this is the actual flotation cost of issuing bonds, the investment banking fees, the transactions cost, as a percentage of the proceeds you get from the new stock issue. So if you're a tiny little company, there are lots of companies with market caps of less than 10 million. You go out and raise less than $1 million in equity, about 20-something% of that will be taken away from you almost off the top. And in fact, this contrasts the cost of issuing bonds versus the cost of issuing stock. In every single tranche, the cost of issuing stock is higher than the cost of issuing bonds. So when you pay dividends and issue shares, even at the very largest levels, you can see a substantial cost. Just as a little detour, one reason costs for issuing equity in the US are so high is because US companies almost always hate to make rights issues. We talked about rights issues way back in the corporate governance part. Remember how a rights issue works? I give every person who holds shares in my company the right to buy an additional share well below today's stock price. And the reason everybody exercises, it doesn't make sense for you not to exercise because you could leave money on the table. So the price is 10, I give you the right to buy shares at 5. A rights issue is very easy to carry through in terms of raising capital because everybody does it. I don't have to pay big investment banking fees. It's easy to pull off. European companies make rights issues all the time. US companies absolutely hate to make rights issues. What's the rationale? Why don't CFOs of US companies like rights issues? They'll say because you're issuing the shares at a discount, there's a dilution effect, more shares outstanding. To which my response is, how come you do stock splits? What's a stock split? It's a rights issue at a price of 0. You do that all the time. Why are you okay with that but not with this? It's true there are more shares, but everybody gets those more shares, right? If you're an existing shareholder, you get a bigger chunk of those new shares. So I've never understood that resistance, but because of that resistance, they have to issue traditional shares, and that cost remains high even for big issues. So if you feel you will have to raise fresh equity in the future, even if you have lots of cash today, it makes sense for you to hold on to the cash. So those are the bad reasons for issuing equity. Let's think of some of the good reasons. There are 3 possible good reasons for paying dividends. The first is what's called the clientele effect, which is if you accumulate investors over time who like dividends, then you better keep feeding them dividends. It's like feeding a monster, though. Be very careful, because the more you feed the monster, the more the monster will demand of you. The second is a story that in finance we become very fond of. Everything's a signal. Signal of what? Something in the future. And that's, in fact, true and at the same time extremely dangerous. But the signaling story says if you feel things are going to be really good in the future, that you're going to make a lot of money in the future, maybe the way you will signal to markets is by increasing dividends. And the third reason for paying dividends is not noble, but it does happen nevertheless. Let's say you're a lender to a company and have a lot of cash. What do you want me to do with the cash? Just hold on to the cash, right? Because as a lender, the more cash I hold on to, the safer you feel. So if I pay a big dividend, guess who I'm hurting first? The lenders in the company, because they now no longer have the cash. So let's talk about each of these, and let's start with the clientele story. And here again, I'm going to draw on a very old study. But it's a study that's fascinating because it goes against everything we were teaching at that time in finance. It's the early 1970s. The classic finance paradigm was, don't pay dividends. Dividends are bad. Investors should not be paid dividends because the tax difference is so large. Every textbook was written around it. So these two researchers decided that they'd found a perfect company to test out this proposition of how much investors hated dividends. It's a company that's still around. It's a northern New York utility called Citizens Utility. And what made it unique was it had two classes of shares. Again, you say, what's so unique about that? These two classes didn't vary in terms of voting rights. But here's what they were different on. You guys get the Class A shares, you get a cash dividend, $1 a year. You get Class B shares, you get a stock dividend. You know what a stock dividend is? You own 100 shares, I give you an additional share for a 1% dividend. Normally stock dividends are useless. They just increase the number of shares. But in this case, as Class B shareholders, if you get these shares, you can at any point in time convert them into Class A shares. So Class A shares get a dividend, you get a stock dividend, but you can convert it right away into Class A shares. Do you see why this is a great way of testing dividends and capital gains? Because in a sense, what have I offered? A company with a cash dividend, or shares with a cash dividend and shares with a capital gain. What did the existing textbook say? Investors should be pricing the shares with the capital gains much higher because they pay less in taxes. So these guys went in expecting to find that. And what they found, it's almost impossible to read the graph, but I'll summarize what they found. They found that consistently Class A shares traded at a premium on Class B shares. That investors are actually willing to pay more for the cash dividend shares without the option they were completely, they actually published it, so I've got to give them credit for not finessing it. They said, we don't understand this, but this is what we found. And then somebody followed up by looking at what kind of investors Citizens Utility had. So I'm going to ask you, and I'm going to give you some choices. You tell me with these choices what they found. Younger or old investors? They found older investors. Richer or poorer investors? Poorer in the sense not having money, but less. So they found younger or poorer investors and a lot of pension funds held Citizens Utility stock. You see where this is going? Those investors like dividends. And because they like dividends, they were willing to bid up the prices of the Class A shares. This has nothing to do with theory and tax law. They don't care. They basically said, we like dividends, we'll pay a premium. And a few years later, this was actually tried out on Canadian utilities because Canadian utilities, many of them have the same set of cash dividend shares and stock. Every single one of them, the cash dividend shares traded at a premium on the capital gain shares. Don't take this as a general lesson, say investors like dividends. In these companies, the kinds of investors they attracted like dividends. And as a consequence, the cash dividend shares traded at a premium. So when you look at these clientele-based stories, that's what you're looking at. You're looking at what kind of investors are attracted to a company. Because here's the basic point. If you pick a dividend policy, you're going to attract investors who like that dividend policy. You pay nothing in dividends, guess who you're going to attract? Investors who don't like dividends. You pay big dividends, you're going to attract investors who like big dividends. You pay monstrous dividends, you're going to attract every dividend addict in the world. Then don't complain. Anytime you change dividend policy, you're also changing your investor grouping, and you got to be okay with that. And when Apple first introduced dividends, that's the point I was trying to make, is you're attracting investors in this company who are very different from your existing investors. Your existing investors want growth and they want price appreciation, and you're attracting investors who want cash flows now and less growth. And you've got to reconcile the two groups because they're going to be at war with each other. In my view, what's happened over the last 5 years in Apple reflects that to and fro you get between these two groups. Because the growth group gets disappointed when they pay more in dividends, and the dividend group gets disappointed when they don't pay more in dividends. You can't keep both groups happy. So basically, when you look at these studies, no surprise, they find that older investors are more likely to hold on to high dividend stocks, and that poorer investors hold on. So when you look across, in fact, the classic way they do this is they run a regression of dividend yields across US companies against a variety of factors like the age of investors, the income, what type of tax rate you're facing on dividends and capital gains. And what they consistently find is older, poorer investors are attracted to stocks which pay high dividends. Okay? And as a consequence, they want those dividends to be continued in these companies. Any questions on the clientele effect? So over time, you accumulate investors who like what you do in dividends, right? So you're saying, what's the problem with that? If I'm a stable company, I can pay big dividends, I'm going to pay big dividends, I'm going to attract investors who like those big dividends. True. But companies do change, right? You could be a nice, stable company and the world can shift under you. And you could very quickly find that you're no longer a nice, stable company, that you're now a risky company that needs to reinvest more. So I'm going to put you in the shoes of a telecom company. Telecom companies used to be among the biggest payers of dividends in the market because they used to be monopolies. So you look at the old, Ma Bell and broken up in 7 phone companies, all paid big dividends. You're the CEO of a telecom company. It's the early 90s, and the world is shifting under you. You're no longer a monopoly. You're more a technology company than a monopoly, and you have all these new investments you need to make. So you cannot continue to do what you've done, which is pay these big dividends and reinvest relatively little. You're in a pickle, right? So I'm going to give you some choices, and you tell me. Think like a CEO, though. Don't think as an intellectual saying, looking at the CEO and giving it. You are the CEO, so you have to live with the consequences. I'll give you the choices, and you tell me what do you think will happen if you pick this choice. The first is you can courageously go in front of your stockholders and tell them that the world has changed. And you're going to cut dividends because you're a risky company that needs a lot of reinvestment. Great, courageous act, followed quickly by your dismissal. It's not fair, right? But that's what will happen if you try to take the bull by its horns. Let me give you a second one. You can continue to pay the dividends that you used to and not make the investments you need to make. Well, that sounds like something you could get away with. It'll hurt your company over time, but you're going to be gone in 3 years anyway. So it's not your problem. But let's say you're forward thinking. You want to make the investments, so you can continue to pay the dividends you used to, invest in the new markets that you have to, and then issue new shares to cover the shortfall. Kind of silly from a cost perspective because you're paying dividends through one window. But you can see why some companies went down this road, which paid dividends, issue shares. But you know what Lucent did? Lucent, of course, was Bell Labs. Bell Labs used to be part of AT&T. So when AT&T spun off Bell Labs, first they gave it a new name to make it sound like a telecom company or technology company. But then they did something very unfair. They saddled it with AT&T's old stockholders. You're saying, so what? AT&T's old stockholders were the ultimate dividend people, right? Because they'd been used to dividends for, 100 years. And Bell Labs or Lucent was given those stockholders. So they're facing exactly this problem. And they decide to go out and keep investing money and doing acquisitions. They continue to pay dividends because that's what their stockholders wanted. And rather than issue shares, you know what they did? They borrowed money, which laid the foundations for Lucent coming apart in the late part of that decade, is they couldn't afford to carry that debt. All I'm saying is I describe dividends as dysfunctional. This is where the dysfunction is going to come to the surface. Because you know what you should be doing, but you're also terrified that if you do it, you're going to lose your job. Okay. Oh, and I said, is there some other choice? Is there something else you could do which is creative that takes care of this problem? What did Verizon do with their cell part of their business? They created a separate company called Verizon Wireless, right? In fact, that was a solution that some of these companies decided. They decided to split themselves up into a phone company and a rest of the risky company. And they did a spin-off. And they made the spin-off go out and seek out investors who liked what they did, which is low dividends or no dividends, lots of risk. It's kind of an intermediate solution where you get to have your cake and eat it too. So that might be a creative solution to the problem, but we need a solution. You cannot keep doing what you've historically been doing because something is going to come apart. Let's talk about dividends as a signal. Yes?
Going back to
does Carl Icahn want a dividend? What did Carl Icahn want? He wanted cash returned to investors. He never said it had to be a dividend. So Carl Icahn is actually, he probably prefer stock buybacks to dividends because of the tax consequences. So when activists push for cash being returned, the choice of dividends or buybacks is either left unstated, or when stated, it's more likely to be buybacks than dividends. Right? Let's talk about signaling. Signaling is fundamental to so much of what we do. I was looking for anybody in a suit today. Nobody around. Usually if you're wearing a suit, I know what's happening. What's going to happen later that day? You have an interview. And why do we wear a suit to an interview? Because you want to signal that you're serious. In the middle of summer, who wears a suit in the middle of summer if you have a choice, right? You're going to wear a suit because you're going to say, look how uncomfortable I made myself for you. And we do this all the time through life. We signal the fact that we're really interested by making ourselves uncomfortable. I'm going to build on that premise in terms of dividends, right? Here's how dividends work. They're sticky, right? So when you increase dividends, you're making yourself more uncomfortable as a company. So if you're a company that makes yourself uncomfortable, you're probably going to be better off if you were able to afford those dividends in the future than if you're not. So what dividends become is a mechanism that allows companies to separate themselves from everybody else. So let's say you have two companies, and you ask the managers, do you have great projects? And both companies, the managers say, yeah, I have great projects. So you can't trust them based on what they say. So if your projects are so great, will you increase dividends? And the company that really has great projects might say, oh, yes, I can afford to pay dividends. I'll increase dividends. Whereas the other company that really doesn't have good projects is going to say, no, I can't go that far. So dividends historically have been viewed as signals, with increases in dividends being viewed as positive signals. And I'll come back and talk about why signaling stories can be turned on their head. But generally speaking, when you increase dividends, you're signaling that you have more predictable earnings and higher earnings in the future. And when you're cutting dividends, you're admitting things have gotten pretty bad. And the way to test out whether dividends are a signal is, remember we talked about the announcement date, where the board of directors comes out and says, increase dividends, decrease dividends, do nothing to dividends. These studies look at what the stock price reaction is to dividend changes. And no surprise here. When dividends are increased, on the announcement of the increase, the stock price jumps. Don't get too excited. It jumps about 1%. And when dividends are cut, guess what? The stock price drops. It drops about 5%. So let me pause right there. When you increase dividends, it's a positive signal. The stock price jumps about 1%. When you cut dividends, it's a negative signal, and your price drops about 5%. Why is a dividend cut a bigger signal? Because it looks like it's a bigger negative signal than a dividend increase is. Why are dividend cuts 5 times more signal worthy than dividend increases? I don't know whether you remember last session I looked at the percentage of companies that did nothing to dividends, increased dividends and decreased dividends. If you go back and look at that graph, you'll notice there are 5 times as many companies that increase dividends as decrease them. And guess what? You're seeing that reflected here. When a company cuts dividends, it's far more uncommon than when it increases dividends. So when you cut dividends, I freak out. Things must be really bad in the company for you to actually cut dividends. Therefore, my price reaction reflects that. So on average, there is evidence that dividends operate as signal, with increases in dividends being positive signals and cuts in dividends being negative signals. But I'll tell you my problem with signaling theory. Can you conceive of a case where you own stock in a company and the company announces it's going to start paying dividends and you view it as a negative signal? Why would an increase in dividends be a negative signal, at least at some companies? Because it's revealing that it doesn't have the kind of growth opportunities it used. Remember we talked about life cycles? Let's say you're investing in a company you think is a great growth company with incredible opportunities, and the company comes out and says, we're going to start paying dividends next quarter. Part of you is happy that finally you're collecting the cash flows. The other part of you is saying, well, if they're paying dividends, it must mean they don't have the kind of investments they used to. So you can actually think of a scenario where dividend increases operate as signals of less growth in the future And as a consequence, you might actually mark the price down. So even though on average the stock price jumps on a dividend increase, in about 25% of cases, when dividends are increased, the stock price actually drops because there's another story that can be told for that company that's a bad story. There is some evidence actually that if you look at, especially when companies initiate dividends, that is a sign that the best days are behind you. What I mean by that is if you track growth rates, so the year relative to dividend initiation, so the dividend is initiated right there, right? 0. So if you look at the years before and the years after, you can see that dividends are initiated in your year of maximum growth. So the year 1 is the year of the dividend. So you initiate dividends when your earnings growth is at its maximum. And what happens afterwards actually is a decline in growth. So there is some basis for the argument that when companies initiate dividends, they're signaling less growth in the future. Is that a bad thing to do? Signal less growth in the future? Not if it's the truth. Sometimes it's better to let investors know up front, you're not going to get that 50% growth that you built into my price. Will your price drop? Yes, it will drop. But actually it's better to have it done now than to have them be surprised quarter after quarter. So dividends can operate as signals. They can affect your prices. The data backs it up. Again, another disappearing graph, right? So take a look at your notes because it should be in your notes. Here's something that does seem to have changed over time. I showed you that graph of what happens when dividends increase, dividends decrease. There's one study that's actually looked at what that changes look like 30 years ago, 20 years ago, 10 years ago, and today. And as you go through time, what's happening is dividends are becoming less of an impact. They're creating less of an impact than they used to on stock prices. Why do you think that's happening? Why are dividend changes less of a signal now than they were 20 years ago, 40 years ago? 20 years ago, how did you get information about a stock? If you were not a trader on Wall Street, if you were a doctor who lived in Iowa or an engineer who lived in Texas, and you'd invested money in stocks, every morning you opened up the Wall Street Journal, you read, if you had the time, you read about your stock. And once a month, your broker might contact you and tell you about what was in your portfolio. So when a company changed dividends, it was actually big news because this was a big information story. Today, you turn on CNBC all day long, there's news stories about every company. The news impact of dividends has gotten smaller as the other news about companies has gotten larger. Our data sources have become richer, so dividends don't operate the way they used to in terms of signal. That's why when people said with Apple, maybe they're trying to signal something, I said, are you crazy? This is one of the most highly followed stocks in the world. They don't need to use dividends to signal anything because there are lots of different ways you can spread that information around. In fact, I would argue, if you buy into this story, that dividend changes will have a much bigger impact at small companies and bigger companies, at lightly followed companies and heavily followed companies, at emerging market companies and developed market companies, because the more additional information you have, the less you learn from looking at dividends. Now comes that bad part of dividends. Dividends are a way in which I can make you worse off as a bondholder. Remember that the 2 pages ago when I looked at what happens when dividends are increased, stock prices go up on average, and when they decrease, stock prices go down. This graph actually looks at what happens to bond prices in companies when they cut dividends. So this is around dividend increases. If the dividends are increased, the stock price goes up. That reflects the previous graph, but bond prices decrease. So when dividends are increased, bondholders feel more terrified, more scared. They mark down bond prices because there's less cash available to pay the coupons and the principal. So what's good for stockholders is often bad for bondholders, which is one reason if you look at loan agreements that banks make with companies, there are dividend covenants. Dividend covenants in the sense companies can't pay out more than a certain amount in dividends. I'll wager that one of the things that's going to come out of this Valiant mess, they don't pay dividends, but if they pay dividends, there have been constraints on how much they can return to stockholders. Because as a lender, you have to put that in. Okay? So those are all reasons for dividends. Let's see if in fact these are the reasons why managers, or what managers think about dividend policy. So this is again from a survey. Don't read too much into it being right or wrong. This is what CFOs of companies think about dividends. So they read statements and asked, do you agree, do you disagree, or you have no opinion? First, look at the no opinion. That's, I think, revealing of... These were CFOs asked about this. Lots of no opinions, so no idea what's going on. So there is dividend payout ratio affects the price of stock. 61% agreed. It does. 6% disagreed. 33% said, I have no idea. Dividend payments provide a signal. 52% agreed, 7% disagreed, 41% no opinion. Markets use dividend announcements as information. 43% yes, 51% no opinion. So basically you can look across and you can see that much of what we've talked about is on the minds of CFOs. It's just not clear that any of it is going to change them from having a dysfunctional dividend policy in the first place. So when you think about dividends, it's actually, it's much messier than the other aspects of corporate finance, because it's not just what's right for the company, but whether you can get this past the investors you've accumulated over time. Okay? So I'm going to at least start on the last piece of this process. So let's think about changing dividends. What pushes companies to change dividends? Because inertia and Me Tooism keeps you in the dividends that you have. So what we're going to focus on is when you choose to return cash to investors, why do you pick, how do you decide what's right for you, whether it's dividends or buybacks, and how does it show up when investors start to put pressure on you? Right? So here are the two approaches I'm going to go through to look at whether your company is paying out too much in dividends, too little in dividends, or just the right amount. Right? So the first approach I call the cash trust nexus. Sounds fancy. But I'm going to argue that any time a company chooses to hold back cash that it could have paid out, then it's up to you as investors to decide whether you trust the managers with your cash. And if you trust managers with your cash, they get an incredible amount of freedom to set dividend policy. Have you noticed anybody complaining about Google's dividend policy in the last year or the last 5 years? I haven't. Does that mean that Google is forever insulated? Not really. Because 3 years from now, if they've been doing badly for 3 years, you're going to see the same kind of questions that Apple faced in 2011. But for the moment, investors trust them with the cash, and they get the freedom to set dividend policy. The less I trust you, the more I'm going to push back and say, give me my cash back. I don't trust you with the cash. So that's the first approach I'm going to go through. The second is a variant of what we did with capital structure. Look at everybody else in the sector and say, what are they doing? Try to be as close as you can, maybe adjusting for your differences in growth and risk and whatever. So let's start with that first approach, the cash trust nexus, because it rests on 3 steps. The first step, I'm going to look at how much your company actually returned to its stockholders, both in dividends and stock buybacks. So I'm just going to go back in time and chronicle that. Then I'm going to ask a second question. How much could they have returned? What's the definition of dividend? It's whatever's left over after you met every conceivable need. If I can see your statement of cash flows every year, I should be able to estimate how much you could have paid out in dividends every year. So how much did you actually return? How much could you have returned? And then I'm going to ask a third question, which is, if you're building up my cash in your company, do I trust you with my cash? And I'm going to ask you, I'm never going to ask you the question, can I trust you with my cash? Because you're always going to say, trust me. I'm going to look at your history. I'm going to look at your history of taking projects and your history of delivering returns to me as a stockholder. Or in more numerical terms, I'm going to look at your Jensen's Alpha and your EVA. And if you have a nice big positive Jensen's Alpha and a nice big EVA, I'm going to say, you know what, I trust you with my cash. Whereas if your stock has underperformed the market and you're taking bad projects, then I'm going to push back and say, give me my cash back. So I'll leave you with this last slide. This slide, I basically look at what each of my companies has returned to its investors over time. So I took Disney, Vale, Tata Motors, Baidu, and Deutsche Bank. I looked at 2008 through 2012. I chronicled the dividends each year, and I also looked at buybacks. Remember, they're both cash returns. So let me start with Disney. Disney returned about $4.5 billion in dividends over these 5 years. Not exceptional, but look at how much they bought back in stock, $15.4 billion. They collectively returned almost $20 billion in cash, but almost 80% of that took the form of buybacks. If you look at Vale, $23.9 billion in dividends, $5.7 billion in buybacks. They did buybacks too, but for them, About 80% of the cash was returned in the form of traditional dividends, only 20% in buybacks. When you look at Tata Motors, 51.4 billion in dividends, 970 million in buybacks. Almost everything in dividends. And look at Baidu, of course, nothing, so that's going to be an easy column. And Deutsche, 4.4 billion dividends, no stock buybacks. So a couple of things to notice. One is, if you look at the dividend column, it actually is a pretty stable column for Disney, right? So you look at the dividend column, it's rising, but it's not doing anything. But look at the buyback column, you see these big jumps forward, big jumps back, much more unstable. But collectively, Disney has returned most of its cash in the form of buybacks, reflecting what we talked about last session. And the other four companies have used dividends the more conventional way of returning cash. So next session, here's what we're going to start with. We're going to start, after the quiz, we're going to start with how to measure potential dividends, what a company can pay. Then we're going to compare the two, and we're going to draw some conclusions about when you'd put pressure on a company to return more cash to its investors.
Sorry, I worked with Tyler last week. I first got into
You're right. That's all you can do is be prepared.
I have two questions about the project.
Yeah.
The first one, when instead of making the bottom-up bet and choosing the companies, the competitors, and everything, can we go to your webpage and use the bottom-up bet that you have for the industry to simplify everything? And second, the company doesn't have a rating. Can I use the methodology, the interest coverage ratio?
Hi, how are you?
I have a company which is cross-listed, and I was wondering whether you think it makes more sense to take a weighted average for the data, or rather just taking one.
You want to use the regression data? Why would you use the regression data?
I thought that you should probably look at both.
The regression data you're going to use to read that regression data. Then when you go to the data for the company,
Just take the bottom-up data for all companies.
yeah,
I have a 9.5 and a 9 in the quiz.
yeah.
You said that you will take the worst quiz and you will pick the two best quizzes.
All the other exams. So your 9 might go up to a higher number if you get a 9.5 and a 28 on the final. So it's basically the weighted score on all your other exams.
But you said that we take 3 quizzes and you take the worst quiz.
And push it up to the average in all your other exams, which includes 2 quizzes.
So should I take the? I should take the.
You should take the last exams. There'll be a lot less pressure on you, right? Because if it does become your worst quiz, it goes away. But if you got a 10, it can push up your 9 up to a 9.5, right? So it can't hurt you. The only people who might be indifferent are the people who got 10s or more. First 2 quizzes.
Yeah.
Then you can't really help yourself by taking the 3rd quiz. You can't hurt yourself. So nobody can ever be hurt by taking the 3rd quiz. But there'll be a few people who cannot be helped because they're too
It's not gonna help them.
Yeah.
Last question.
Yeah.
Next semester you're gonna do valuation. I'm taking valuation with Professor Angelin. To apply for being your TA. How it works?
Just email me. So I have one TA already. He took the class in the fall, but I only one. So if I need a second TA, I'll reach out to you. Just email me.
Okay, thank you.